Let's get a New Zealand perspective on these share market jitters. We're joined by Auckland Foreign Exchange Advisor Derek Rankin from Rankin Treasury and also by Rob Mercer of Forsyth Barr. Good morning to you both.
Good morning.
Derek, first of all to you. Well, we've heard some news from the Australian end and from Wall Street. Put it all together for us. What's your overall picture of how the global market's sitting?
Well, I think there's a wall of worry out there. I mean, really the US job numbers on Friday night was the end of a process we've been going through for the last couple of weeks, really. I mean, the Greek elections, they're talking about walking away and telling Europe to they're not going to pay their money back and maybe talk of moving to the drachma again. There's been a Spanish run on the Spanish banks. The data we had in the last couple of days, 66 billion euros left Spanish banks in March. We had a range of purchasing manufacturing data from a number of countries last week. China's as well. They're all indicating contraction. And then we had the US employment report. So it's all not good. And when you look at the share markets for May, the major share markets are down something like 6 to nearly 7% across the board. And employment, we've got 23 million Americans unemployed. So the thing is, with Spanish interest rates heading towards 6.6%, there's a big problem in Spain. And overnight we've had announcements that there's going to be G7 discussions today to see what we can do about it.
All right. Rob Mercer, what's your view and on, in particular, how it affects the New Zealand economy?
Well, it is a challenge at the moment. I mean, it's not new. I think every time the market goes up, we think it's all fixed. And when we go through periods where it contracts, we get all worried again. And I see Europe as a problem. And they're prolonging the inevitable. They need to get on and sort out reset the financial sector, recapitalise the banks, and somehow let the productive sector start to drive them out of their current predicament. But that's not going to happen overnight, and we'll let them make all those final decisions. When it comes to China, obviously the growth there is causing some issues. I mean, for Australia and New Zealand, very much synced to the emerging markets and the Asian markets in particular, with food and resources. And so those areas are coming up under some pressure. But they're a big economy. They are able to stimulate both fiscally and monetary, and I think they can manage their growth back towards the 10% level.
All right.
Currently, the current concerns of coming in under 7 is sort of what's catching the headlines. So when you look at equity markets, yes, we've seen a bit of a pullback. Some of the European markets and Asian markets are down 20% over the last 12 months. A lot of falls in the last, since February, March, came from quite a strong start to the year. But I think still, if you come back to New Zealand, it's a little place, but we're doing well. We can be proud of the work the corporates have done.
All right.
So the gross return, the gross yield here is 7%, and the corporate profitability is stabilised. It's not growing substantially, but certainly the level of earnings has actually been quite stable. And so I think we'll have to ride the current wave of negative news at the moment, but stick with quality end stocks, stocks that are already performing well in terms of earnings, and that are well priced. And
all right. And I just want to quickly go back to Derek Rankin on one quick question. Derek, any good news for exporters on the currency, though, for the Kiwi?
Well, the currency's actually continued to come down. In actual fact, in the last couple of weeks, it's actually stabilised around that 75 area. So when you actually look at the ANZ commodity numbers came out on Friday. In actual fact, when you look at those numbers, the commodities are actually down, but in New Zealand dollar terms, we're actually starting to move back up again for exporters. So that sort of natural safety valve of the currency is giving exporters relief. In terms of better returns for their exports, and so that's good news. And our interest rates continue to come down. Our long-term interest rates for government borrowing, we're regarded in the safe category. We're not one of those countries which have major problems. So we've still got a lot of foreign investment coming in here. So that's good news as well.
Thank you both for that. That's Derek Rankin from Rankin Treasury and Rob Mercer from Forsyth Barr.